Okay, well, hello and welcome everyone. My name is Amanda Glasson, and I am the graphic designer and YPN liaison with the South Bend Regional Chamber. First, thank you so much for joining us today. I'm excited to see such a great turnout and also looking forward to getting a little inside information on some of those burning tax questions. But before we get started, I need to go over a few housekeeping notes. As you may have realized, we're not able to see or hear the audience, but would still like to make this as interactive as possible. Please feel free to put any questions in the Q&A section or chat and hit that little hand icon to raise your hand and let us know there is something you would like to ask, and we'll do our best to get to as many of you as possible. Thank you to those of you who submitted questions ahead of time too. We wanted to shape this event around you as much as possible, so we appreciate it. Next, I want to thank Gibson, YPN's program sponsor, for believing in our young professional community and helping make events like this possible. We appreciate you championing YPN, and if any of you think your company would like to support YPN programming, please reach out to myself or Sherry Carroll with the Chamber. On that note, I also want to encourage you to come to our next networking opportunity, a March Madness watch party on March 18th at La Casa de Amistad. Should be good, and we hope to see you there. Enough for me. I want to introduce you to Shabir Kutbin, who will be your YPN host today. Shabir is director of the IT sector partnership at Ivy Tech Community College, where he also serves on the visionary board of emerging leaders. He is one of our new ambassadors this year, and we are thrilled to have him, as he always has a smile on his face and is willing to help in any way possible. Lots of great ideas too. So thank you, Shabir, for stepping up today, and I will now hand it over to you.
Thank you, Amanda. Good afternoon, everyone. I would like to introduce today's speaker, Brian Ulrich, tax manager at Kruggel Lawton CPAs. Brian has gathered experience in tax services for individuals, corporations, and partnerships for several different industries. He pursued his bachelor's in accounting and economics and finance from Bethel University and joined the Kruggel Lawton CPAs in 2021 after gaining several years of experience at a national firm. His service areas include partnership tax preparation, corporate tax preparation, individual tax preparation, tax forecasting and projections, multi-state taxation, and research for federal and state tax issues. Brian is a member of the American Institute of Certified Public Accountants and the Indiana CPA Society. He has also volunteered with the Elkhart Community Schools, CARES programs, Feed the Children, Pet Refuge, and Junior Achievement. In his free time, Brian enjoys spending time with his friends, golfing, and cycling. He also loves reading and traveling to the West Coast. He met his wife, Marissa, while studying in college, and they have a family of 2 cats. Brian, thank you so much for joining us today, and I'll pass over the reins to you now.
Thanks, Shabir, for that kind introduction. Hopefully everyone can see my screen. Now?
Yes.
All right. All right. Yeah, as Shabir said, today we're going to be talking about tax tips, trends, and tactics. I do want this to be interactive. I have obviously some slides prepared, but if you have questions as you go, he'll be monitoring the chat. We can talk about them as they come up, or we have time at the end allotted as well. So going through the goals for today, you can see there, I want to talk about notable changes from prior years, items often overlooked, areas of confusion that we see, and some opportunities that we can take advantage of. Now, kind of the inherent challenge with talking about tax, individual tax, especially in an hour-long presentation, is we have a limited amount of time, and taxation, individual taxation, can be as complicated as you want. I tried to cater many of the talking points to young professionals. You know, oftentimes they have different tax issues than other demographics in life, but even young professionals, as I saw from questions coming in and from seeing other returns, you can have everything from just being an employee of a company, you receive a W-2, maybe you have some interest income, maybe you have maybe you have a home, maybe you rent, maybe you have gain or losses on sales or transactions. That's on the simpler end. But, also reported on an individual tax return is sole proprietors. If you have an LLC with one owner, that basically business return is reported on your individual return. So you've got business taxation issues. If you can have rental income or farm income also being reported. So it can get very complicated very quickly. All that to say, I tried to cater this more to a typical YPN, if there is such a thing, but please ask questions. I'll do my best to respond or can get back to you after if we need some additional analysis. So the first question we get very often is who's required to file? In general, and I will be saying in general a lot because the tax rules, while there are often standard rules, there are exceptions to that rule, loopholes, and other rules put in to cover those loopholes. So in general, if your filing status would be single, you aren't required to file. If your income would be under $12,550. If you're married, I believe that amount is double. However, you are required to file if you have over $400 in self-employment income. And so self-employment income, for those who don't know, if you're carrying on a trade or business as a sole proprietorship or an independent contractor, you often will have self-employment income. So if that's the case, you still may need to file even if your gross income's under that amount. Also, if you can be claimed as a dependent by someone else and have unearned income over $1,100, you're required to file. This is primarily in place to stop, high net worth individuals from moving income from their own return to a dependent or to a child who wouldn't be taxed or would be taxed at a much lower rate. There are also some instances where you may want to file if you had tax withheld that you can have refunded, even if you're under the amount and wouldn't have to. It would generally be beneficial for you to file. Other questions that we get a lot are, should I use a paid preparer or should I do it myself? I can't answer that necessarily. I can give you some reasons why paid preparers are beneficial, and I will. But ultimately, that's kind of a cost-benefit analysis by yourself. I will say paid preparers, one of the big benefits is you get multiple sets of eyes on it. Those sets of eyes generally have the specialized knowledge. They've seen your situation before. They work with someone who's seen someone with a similar situation. And, throughout the year, there's someone to answer questions or bounce ideas off of. And some people just want the human element. That they don't want to be involved. They want to collect their documents. They want to get it to a preparer. They don't want to take the time to take a weekend or take a night and go through doing it in the software. On the other hand, doing it yourself is a bit of a misnomer. You're not going to the library and picking up the tax forms and completing with a pen and a calculator like it used to be. Doing it yourself generally means you're using one of the big software companies. I would say those companies generally, they do a good job. The thing is, you need to go through and answer all the questions properly. I would recommend printing and looking through the forms when you're done before filing and understanding what's being filed. But if your situation isn't overly complex, most taxpayers are capable of filing their own returns via those software companies. Now, I do want to point out a couple other options. The IRS website does have a free file option if your adjusted gross income's under a certain threshold. They don't necessarily have a filing program on there, but will refer you to other softwares that maybe are free or have your state included. That's kind of been hit or miss from what I've heard. Sometimes libraries will have like tax assistance programs. I did mention on here Notre Dame has one, generally for lower income individuals in the Michigan area, but a few days a year, I think the Notre Dame students, in conjunction with CPAs and other people in the area, will get together to help people. So that could be a resource if you have questions or if you know someone who fits the required criteria. I listed some other big players. People often ask if we have recommendations. I don't necessarily have a recommendation. I like using whatever software I used the year previous because it would have all my information already saved in there. That's going to be easier. And it would have detail of what I put in last year, possibly, so I could more easily see, hey, I had mortgage interest last year. I didn't put anything in this year. Maybe I'm missing that. So actually, talking through the completion of the form, the first two things you need to determine are your filing status and how many dependents you can claim. I think most of you have probably worked through this analysis already. I will say filing status, there are two different statuses. There's married filing jointly and married filing separately. It's almost always more beneficial to file jointly with your spouse. There are a few exceptions to that rule, few and far between. And then as far as claiming dependents, the Tax Cuts and Jobs Act in 2017, it reduced the personal exception you got for claiming dependents, but the amount of dependents you claim can still boost your tax savings via other credits, child tax credit, credit for other dependents, earned income credit, stuff like that. So you still need to go through and understand who you can claim. In general, it's your children or a or someone else you provide over half of their support. The IRS has worksheets, interactive worksheets on how to claim. There are a lot of rules, exceptions to the rules, but I would say in general, it's your children. Actually getting to completing the forms. The first part, you report your income and your adjustments to income. Now, like I said, this could be a whole day's webinar on what type of interest is taxable, what type of dividends are taxable. For most salaried employees, you're going to get a W-2. Maybe you'll have some interest. Maybe you'll have some of these other things. I don't want to get super deep into that. I do want to call out some items where things have changed or we've seen significant complexities lately. That gain or loss bullet point, that's not just gain or loss on sale of stocks. That's also other gains and losses, including gain or loss on sale of cryptocurrency, which has become, very popular in the last few years. One complexity with that is just the decentralized nature of the cryptocurrency and the lack of regulations behind reporting of basis and proceeds to the IRS. Right? If you buy stocks on a brokerage, they're going to send you information on your cost basis and proceeds. They're also often sending that information to the IRS. That isn't necessarily the case for cryptocurrency, and it can be administratively difficult to track through what you purchased that for and what you sold it for. So that is something to be aware of. Another thing to note, gambling income and excessive losses is income that you would need to pick up on the federal return. But if you have losses that exceed your income, that's not a deduction for you. So I also mentioned business income, rental income. Again, if you're an independent contractor, you're going to complete Schedule C. you're going to be subject to self-employment likely, and that will allow you those are complete separate forms, more like a business return that kind of flow into this section. We'll talk about them a bit more later.
Brian, there are 2 questions on the chat.
Yep. Okay.
The first question is from Selena, and she's asking, is there a minimum threshold for the gambling bullet point? She's given an example. If you want a net $10 on a sports betting, for example, do you still need to report it, or is it only for really large amount?
I believe, well, you're able to net that with your losses. So if you've lost $10 throughout the year, your net gain is 0. Or if you've lost $100 and you won $20 on one bet, your net loss is still 0. There's nothing to report there. But I mean, I think the technical right answer is if you win $10, that's your only transaction, that should be reported as income.
Other question is from Ashley. What document do we need to make sure we have the student loan interest deduction?
Yep, that's the next column. We'll talk about adjustments to income. I listed a few there. Again, there are many more income items. There are many more adjustments to income. But one of the things is student loan deduction is available. There's no required documentation. You should receive, or you likely receive, some type of document, some type of 1099 with the student loan interest that you paid, or you could look that up possibly. That's nothing that needs to be, you don't need to provide documentation to the IRS. If you were to get audited, in that rare instance, they might ask for support, but that's something that you don't need to send with your return or anything like that.
And the last question is from Michael. If you are invested in crypto, but less than $2,000, is that something you need to claim? And is there a threshold?
Yeah, I'm not aware that there is a threshold. So invested in crypto is different than you're able to buy cryptocurrency just like you're able to buy a stock, and that's not a taxable event. But if you sell it for a gain or loss, that would become a taxable event. So no, but there wouldn't be a threshold there or anything like that. All right, moving on for now. So we started with picking up all our items of income. So we get to an income, a total income number. From there, we're able to deduct well, you can pick either the standard deduction, or you can choose to itemize your deductions. Obviously, the taxpayer is going to pick what's most beneficial for them. But I will say, when the personal exemptions that we talked about for children were phased out, the standard deduction was greatly raised. You can see that those amounts by filing status on the chart in the middle of your screen. Those are generally more beneficial than itemizing your deductions. You should still do the analysis. The amount of itemized deductions, that's a whole separate form on the return, and these are things that are often thought of as deductions, things that you're told to keep your receipts for: taxes paid, real estate taxes paid, personal property taxes, mortgage interest, charitable contributions, and certain medical and dental expenses. So the correct answer would be to go through the analysis each year, look at all those. You should be tracking all those, or have all those. Look at which one's more beneficial. I would say for young professionals, it's not virtually certain, but it's very likely that the standard deduction will be more beneficial for you. But still should go through that analysis. One other deduction here as well at the bottom: taxpayers, in addition, can deduct $300 if you're single, or $600 if you're married filing jointly, of charitables, even if they don't itemize. So as you can see, charitable contributions are one of the itemized deductions. But so if you didn't itemize, you didn't get that deduction. But I believe it was a smaller amount in 2020 and expanded in 2021. So that's something that could certainly be beneficial.
Brian, there's another question from Ashley. She's saying, I remodeled kitchen and bath this year. Are those deductibles?
Yep, that's a good question. I'll answer it in context of this next slide here. So some of the things like that maybe you think of as a write-off often aren't write-offs unless you have, in some instances, if you have a rental property or you're an independent contractor or have a Schedule C business, you do have the ability to deduct ordinary and necessary costs directly related to operating your business. So if you have a rental, just a house you rent out, you pick up the income on that, but you are able to deduct, and this can get complicated because some repairs you're required to capitalize, some you can immediately deduct. Mortgage interest, you can deduct that you paid other supplies or other things like that. Can be deducted in certain instances, but for most taxpayers, if it's not a rental or a business, no, those are not deductible things. So I think that's really all I want to say about this slide as well. The analysis, I mean, basically these are business returns reported on your individual return. There's a lot of analysis that needs to be done. I mean, if you say you have a car for your work, are you able to immediately expense that? Is that something that needs to be depreciated? There's a lot of it depends there, and probably outside the scope of what I want to talk about in this hour. So at a high level, we've gone through, we've recognized all our income, we've adjusted income maybe slightly, and then likely we took the standard deduction. Now we're at our taxable income. From here, we figure the amount of tax due, and these are slightly simplified because capital gains are taxed at a slightly different rate, but in general, the charts are on the right here. For an individual taxpayer and a married filing joint taxpayer. So you can go through the analysis. Obviously, the software will do this for you, or whoever will do it for you. But it is interesting to look at. Some people don't realize that the tax brackets are graduated. So sometimes you'll hear, hey, I don't want to make that bonus. It'll push me into a new tax bracket and I'll have to pay a lot more in tax. Well, that's just not the case. You figure a marginal rate based on, the first portion taxed at this amount, the next amount taxed at that amount. You're never going to get to a worse outcome by increasing your income. The first so much is always taxed at the same rate. We are going to talk about some credits on the next slide. So I do want to talk a little bit about the difference between a credit and a deduction. So a deduction is a reduction to income, whereas a credit is a reduction to actual tax. So because the deductions we talked about previously reduce your income before it's being multiplied by this marginal tax rate, those are just less valuable than a credit, which is basically a one-for-one offset of tax because it's after being multiplied by the tax rate. So here are some common and expanded credits where I think will be applicable for many YPNs this year. So the child tax credit is the big one. That was expanded and prepayments were made during 2021 of that credit. So as you complete your return this year, you'll need to figure what credit you're entitled to. You can see some numbers there. There's also a phase out if you make too much money. And then you'll need to reconcile that against what prepayments of that credit you've already received to determine how much additional is able to be claimed with your return, or possibly you could owe it back. I don't think that'll be the case for most people, but if you made significantly more income than was expected and you were phased out of the credit, that theoretically is possible. Similarly, the stimulus payments, it seems like ages ago now, but the third stimulus payment was announced and most people received in spring of 2021. If you didn't receive that and are eligible, it could be claimed on your return this year. That was basically a similar to the child tax credit. It was a prepaid credit, but there's no clawback if you were eligible then but are not eligible now. But if you missed it for some reason, you can claim it now. On to the next one. Tuition and fees were previously a deduction, but now that expired at the end of 2020. So now 2 credits were actually expanded, the American Opportunity and the Lifetime Learning Credit. I would just be aware, if you paid tuition and fees, you should certainly look into that or make sure you're inputting those in the software because there could be value there. Similarly, the Child and Dependent Care Credit, if you paid expenses for the care of a qualifying individual to enable yourself or your spouse to work or look for work during the year, there could be a credit available. Now, those credit amounts, you'd have to have significant expenditures to actually get to those credit amounts, but there could be a benefit nonetheless.
Brian, we have another question. If I use a dependent care account to get pre-tax wages to pay for eligible daycare costs, can I still qualify for the child dependent care credit?
Yeah, that is a good question. I'm not sure offhand. Possibly if the dependent care account. Yeah, I guess I'd have to look into that. I'm not sure offhand. I will have my email address on the last slide if you have questions where, like I say something like I don't immediately know, or you have other questions that are very individual specific, feel free to shoot me an email. I've got plenty of free time this time of year, so I'd be happy to look into those for you. All right, so we've gone through the analysis. We've picked up our income, reduced it by deductions, calculated what our tax due was, then we've reduced that by credits, any credits that we're entitled to, in addition to possibly withholding that was done on our W-2, or if you're an independent contractor or someone that made estimated payments, you're reducing it by estimated payments made during the year. Now you come to the point where you determine, well, what's my refund, or heaven forbid, do I owe money? So one thing to note, whether you owe or get a refund doesn't change your tax liability for a year, just the timing of when the tax was paid to the government. I know people often watch the number, or they're working in the tax software and they watch, oh, what's my refund amount? In fact, I mentioned the Tax Cuts and Jobs Act. That was Trump's big tax cut in 2017. So the next year, there were reports of plenty of people getting a smaller refund than they got in the past, and they thought, hey, I thought my taxes weren't going to go up on the middle class. What's the deal with this? Well, what they didn't realize is they had less tax withheld during the year from their W-2, so they just got less of a refund back at the end of the year, but their total tax bill for the year was less. A lot of people don't necessarily look into that. So what's optimal? I mean, do you want a big refund? Do you want nothing? That's somewhat subjective. Some people would argue that you want to have withheld exactly perfectly throughout the year, so you owe nothing and get no refund with your return. That way, the government wasn't able to hold on to your money throughout the year, and you didn't give them an interest-free loan. Some would prefer to, overpay a bit each pay period and then get a sizable refund back. Just psychologically, that's preferable to not knowing exactly or to possibly owing. I will say, if you do owe, or if you want to adjust your withholding, if you're an employee, you can always update your Form W-4. The IRS, well, that's a few pages long. There are worksheets there to help you if you have special circumstances, which I guess, as you've seen, the calculation of tax can be very complex. So if you just fill it out and say, hey, it's just me and or I'm single, or I'm married filing jointly with one kid, there are charts on how much they'll withhold, but that can't take into account all your facts and circumstances. There are additional worksheets behind there. The IRS has some worksheets or some interactive things you can fill out to help you understand if you should have more withheld throughout the year, or how exactly to fill out that form to tell your employer what you need. If you're an independent contractor, like a realtor or an insurance agent, you'll likely have to make estimated payments. You won't have the luxury of having an employer withhold throughout the year on you. So you can't have withheld, but you can look at your prior year tax and go off that. All right, this is my last slide here, and I'd be remiss. We've talked a lot about at the federal level. Most of us, or likely all of us on this call, will still have some sort of state filing to complete once we're done with the federal. A lot of that information will flow from the federal. The states commonly start with, your federal gross income before having some deductions and credits of their own. I do want to note, Indiana does provide a property taxes paid deduction, which is an itemized deduction for federal purposes. So is something you could potentially miss. Even I know people leading webinars about tax have missed that on prior year returns and had to go back and amend. So I know it can happen. And then Indiana also has a renter's deduction. So if you don't pay Indiana property tax and you rent, there's still a possible deduction for you that you wouldn't have had to input on your federal return at all. And then very quickly, we'll talk about your filing footprint. Generally, you need to file in your state of residence and where income is earned. So if you live, we have plenty of people in our area who live in Michigan, work in Indiana, some vice versa. They're often required to file in both states, or will be required to file in both states. That doesn't mean they're paying double the tax. You're able to claim a taxes paid in other state deduction on the state where you live, but it can get complicated really quickly. All right, that is the big talking points I wanted to talk through. I'm open for questions. If I missed your question, I think I saw everything that went on in the chat as we went.
You can ask your questions on the Q&A, or you can also raise your hand and we'll allow you to speak if you have any questions for Brian. So I just got a question from Jasmine. I just became a realtor. What do I need to file?
Yep, so independent contractor. We touched on it kind of briefly, but if you're an independent contractor, you're filing Schedule C, which is that profit or loss from trade of business. That'll allow you to deduct your related expenses. So you'll probably have like mileage and other things like that. You'll also need to file Schedule SE, which is the self-employment tax. We talked about that briefly as well. Or maybe we didn't talk about it, but self-employment tax basically is additional Social Security and Medicare tax that most employees would have withheld just from their W-2. If you're self-employed, you don't have an employer withholding that. So that's just you need to complete that form to basically pay your share of those payroll taxes. And then also estimated payments may be required.
Selena, you can go ahead and unmute yourself and ask a question.
All right, awesome. Well, thanks for all of the info, Brian. If you're like considering buying a home and you're looking at the difference between maybe a 15 or a 30-year mortgage, and like you could possibly afford either one, like are there can you talk a little bit about like the tax advantages of mortgages and like whether there's any advantages to choosing like the 30-year one besides obviously just like paying less?
Yeah, tax advantages, I think would be minimal. I mean, we went through, the only thing I can think of really is your itemized deductions. So your mortgage interest paid,
Mm-hmm.
if you're in a spot where you're able to itemize your deductions, that, I mean, if one allows you to pay more interest, you get a bigger deduction. But from as far as tax consequences, there really wouldn't be much, especially since itemizing is more and more rare.
Gotcha. So if you're like not itemizing, then it really doesn't matter as much.
Right. There used to be a first-time home buyer deduction or credit that's no longer available. So,
Gotcha.
yeah.
All right, thank you.
Brian, Julie has a question for you. I closed on a house in December. Does this impact my 2021 returns in any way?
Yeah, I think it's going to be a very similar answer. Minimally, possibly you have, or if you, I mean, there are some itemized deductions that if you were to itemize could benefit you. Like you may have paid some real estate taxes, you may have paid some mortgage interest. I think likely those won't be enough to push you from a standard to an itemized deduction. And then there's, I mean, you'll need to update your return to your new address if that's where you're filing from. But no, not really any big reporting items for you. Now, we can't talk about when you do sell your house. There is an exception. Most people know if you're single, you can exclude up to 250,000 of gain, or if you're married, it's 500,000. That's assuming that house was your primary residence, which I think they define as you lived there 2 of the last 5 years or something like that. It's in order for to not have people that have rental real estate or buy and sell real estate to claim that exception.
Another question is from Sushila. Can moving expenses be claimed if one spouse is moving?
Yeah, that's a good question. I believe those were nixed last with the Tax Cuts and Jobs Act. I don't think that's a deduction anymore unless you're maybe qualified military. I'd have to look into it more. I don't think that's a sizable deduction anymore, or even a deduction.
There's a question from Kyle. Can you speak to the mechanics around backdoor Roth IRA conversions? Specifically, what happens if the funds are added to the non-Roth IRA in the year following the tax year, which is prior to April 15th, but are then declared as a Roth contribution for the tax year?
Yeah, backdoor Roth. I can't speak that much to it. I mean, what you're listing there, yeah, as far as tax consequences, it's a way to avoid some tax. I don't. Sometimes we see it used by by financial folks. I don't have a ton of experience with it, so I can't say much on it at the moment.
Are there any other questions for Brian? Brian, Michael is appreciative of your insights. He's saying that it really appreciate your shedding some light on what can be rather intimidating topic.
Thank you, Michael Scott.
So we had some questions that we got in the registration form. I can probably ask you one of those questions. So Brian, can you add on what are the tax implications you should be aware of when major life changes occur, such as buying a home, getting married, or having a baby?
Yeah, we talked about the home a bit. Getting married, you're able to, so as long as you get married by December 31st of whatever tax year you're filing, you're able to file as married filing jointly if that's desirable. And in almost all instances, it is. So you can file that way for the entire year. So you should, I mean, so that'll certainly be a benefit. You'll likely have lower tax paid from that and increased standard deduction, things like that. Having a baby, that'll be able to be included as a dependent, no personal exemption, but we talked about the child tax credit a bit. So $3,000 in credit for children under the age of 6. So there should be an additional child tax credit available for you. And I guess one thing to note, the IRS wouldn't have known about that child when they made the prepayments. So that's just something you'll need to reconcile as well. You'll be enabled, or you'll be entitled to even more of a refund or of a credit probably.
Another question is there anything one should know living in Indiana and thinking of going back to grad school or tax savings with 529s?
Now, I know Indiana does have a deduction for 590 or 529 contributions. As far as other things to know, grad school. So I know we're talking about credits here, those tuition credits. The American Opportunity Credit is generally available for your first 4 years of post-secondary education, where the lifetime learning credit is for those of us thinking about going back to school, generally any tuition fees paid after those 4 years. So that's really going to be the big federal credit. There could be an Indiana deduction for contributions made to a 529 plan.
One more question. If you had a child later in the year, do you get the full child credit or only a portion of it?
I believe you get the full credit. It's just, I think it's just like married filing jointly. You don't have to prorate that. I believe you get the entire credit.
One of the other questions we got from the registration form was, I'm a new realtor and I wanted to know how I should file my tax return since this will be my first time filing as an independent contractor. What new forms must I fill out? I did not make any sales last year, so can I still deduct business expenses?
Yeah, we talked a bit about the independent contractor filing, filed on Schedule C, self-employment tax, need to make estimates. The other wrinkle there is not making sales in the year. Are you still able to deduct expenses? And the answer is, it depends. I believe the rule is those are basically startup expenses. You can deduct up to $5,000. If your expenses are over that, those are required to be amortized over 15 years. But possibly your expenses are under that if you didn't have any sales in the current year.
Are there any other questions for Brian? All right. Thank you so much, Brian. And I'm going to go ahead and close our meeting now. Thank you, everyone, for joining us today. We hope you found Brian's presentation informative and he was able to answer your key questions. I want to thank Gibson again for supporting YPN and remind you all to check out our events calendar at ypnsouthbend.com. I hope to see all of you at our next event, which is the March Madness Watch Party. It is a happy hour networking opportunity at La Casa de Amistad on March 18th. I'm going to post the invitation link on the chat so you can register. Also, please keep your eyes open for any information on the women's panel we are planning for April. I want to thank everyone again and have a great day.
Thanks, Shabir. Thanks, everyone.
Thank you, Brian.